If you've been reading the financial news lately, or even just scrolling through social media, you might have noticed a very specific, very heavy cloud hanging over the American economy. Bosses, investors, and policymakers, they all seem to be whispering or shouting about the same thing, a coming Jobs-Pocalypse. The narrative goes something like this. We are living in a K-shaped economy. That means while the stock market is partying at all-time highs and companies are pouring billions into artificial intelligence, ordinary people are being left behind. There is a growing sense that economic growth and actual job creation, which usually move together like best friends, have started to drift apart. It's gotten serious enough that the Federal Reserve has stepped in, cutting interest rates at their last two meetings. Jerome Powell, the chair of the Fed, calls this risk management, basically taking out an insurance policy against a deep economic crash. But here is the question we need to answer today. Is the sky actually falling? Or, if we look closer at the data, is this gloom completely overdone? The reality check. Before we panic, we have to look at where we actually are. The truth is, American workers have been on an incredible run. For nearly a decade, if you ignore that brief, chaotic window during the COVID-19 pandemic, the unemployment rate has been bouncing around near 50-year lows. And it's not just about having a job, it's about what that job pays. Wages have surged fast enough to actually beat inflation, even when inflation was at its highest since the 1970s. And here is a surprising stat that often gets ignored. The poorest Americans have actually flourished the most in this environment. Since 2015, real wages for the lowest earners are up by 19%, compared to just an 11% rise for the highest earners. So, if the track record is so good, why is everyone so terrified of a crash? The three pillars of fear. The case for the Jobs-Pocalypse really rests on three specific worries. First, there's the momentum argument. Even if things aren't a disaster yet, they are moving in the wrong direction. Job openings have been slowly dropping for 2 years, and unemployment is creeping up. The scary part about employment data is that it doesn't usually slide gracefully. It tends to grow slowly and then crash quickly. The second worry is layoffs. It feels like every week a major company is announcing cuts. Amazon and Verizon have announced plans to lay off tens of thousands of people. In fact, excluding the pandemic era, private sector firings spiked in October to their highest level in over a decade. And third, there is the vibe shift. Consumer confidence is terrible. It's near a record low. According to a New York Fed survey, people are genuinely scared. Respondents believe their odds of finding a new job in the next 3 months are under 50%. That is actually a worse outlook than they had in the middle of the pandemic. Why the optimists are right. Now, let's flip the script. Despite those fears, the counter-arguments are actually much stronger. Let's look at that creeping unemployment rate. It is currently sitting at around 4.4%. By historical standards, that is incredibly low. In fact, since 1948, the unemployment rate has been higher than it is now, nearly 75% of the time. And those payroll numbers that had everyone worried over the summer, they got revised upwards. In September alone, the economy added 119,000 new jobs, which was more than double what forecasters expected. But what about the recession indicators? You might have heard of the SOM rule. It's a formula that predicts a recession when unemployment rises sharply. While we briefly dipped into the danger zone in August 2024, the rise in unemployment has been slow this year, and we are nowhere close to the recession threshold right now. The future. Finally, we have to look at why hiring might have felt slow recently. It might not be a broken economy, it might just be uncertainty. There is a strong argument that companies hit the pause button because of Trumpian uncertainty regarding tariffs and policy changes. But as the rollout of those policies becomes clearer, the chaos seems to be receding. The broader economic engine is still running hot. GDP growth is on track for a massive third quarter. The stock market is soaring. Even the fear that AI is going to automate everyone's job tomorrow seems premature. Conclusion. So here is the bottom line. While 2026 might not be a year of perfect calm, it is likely to be less frenzied than people fear. As long as the rest of the economy keeps rolling, and the data says it is very difficult to imagine the labor market just collapsing. While investors and central bankers are stressing out on the sidelines, the decade-long hot streak for the American worker looks like it has a little bit longer to run. Thank you for watching. If you find value in this content, I invite you to subscribe and stay connected for more insights.